All right, so I just want to run through this section here of page 390, question 2 in the book, because it's a little bit different to the example that I went through in the other video. From here on, kind of in how the loan is going to be repaid is a little bit different, but I'll run through the whole thing quickly. So Rhodes borrowed 140 grand on the 1st of April, part of which was used in extension costing 120. So we've seen this before. So the 140,000 euro. So when you take out a loan, you actually receive that money then, okay? So that 140 is going into the bank account on the receipt side. So this bank T account you use to get the closing bank balance, all right? It is generally left out of the bank lodgements up here, the money that you get. So you put it in on the receipt side in that T account, and then it is not repaid for at least another 3 years, or about 3 years, isn't it? So it goes into the balance sheet down in financed by. So your creditors due after 1 year, there's your 140 because you'll be paying that back after more than 1 year. The 120 then you use to purchase a fixed asset. Okay, that is left out of the bank payment section of the information you're given in the question, but you are paying 120 grand to purchase some premises, so it should go on the payment side of that bank T account. So the two of them are often left out of the lodgements and payments information that we're given. So just don't forget to put them into the bank T account. The 120 grand is the purchase of fixed assets. So you'll also add it on to the fixed assets that were already there from the start of the year, the 1st of January, in coming to your fixed assets at the end of the year. You have interest then, which is dealt with in the normal way. So it's 12% of the 140 grand, and then you only get the loan on the 1st of April. So that's 9 months interest for the year. So it's a 140 grand loan by 12% by 9 months. That's 12,600. So that's what would go in the profit and loss account. But later on in this question, it says 10% of interest payable for the year is for the private section of the business. Okay, so it's for his own private use. Okay, so you're going to take 10% of that and put it into drawings. So 90% of that number will appear on the profit and loss account as your interest for the business, and 10% will go into drawings for that private use. Okay, so it's the interest payable is where you make the adjustment. Okay, it is still, however, it's the company's funds that this interest is coming out from. So the company is paying this. Okay, so it is still this 12,600 you use to come up with the interest due for the current liabilities. Okay, so you've got 12,600 interest for the year. You have already paid 4,000 according to the bank payments. So 12,600 take away 4,000 is 8,600 due. Okay, so that 8,600 is going in on the current liabilities. Okay, but in the profit and loss account, 12,600 take away 10% for drawings is 11,340, and then the 10% is getting included with drawings down here. Okay, you'll see those workings and those totals in the solution. All right. Next then is the kind of new bit. It's a bit which is a little bit different to what's in the example I did. So the capital sum was repaid in one lump sum in the year 2005. So we're not repaying any of it this year or next year. It's all going to be repaid in a few years' time. That's why it's all going into long-term liabilities, creditors due after a year. To provide for this, the bank was to transfer 1,300 euro each month from the business bank account into an investment fund beginning on the 30th of April. Okay, so the money is going to be paid back in a few years' time in one lump sum. Okay, but so that we have money to repay that in 3 years' time, we are setting aside 1,300 euro a month. Okay, so this 1300 is basically been put into like a savings account or a deposit account, and it's just going to sit there for 3 years. It's going to earn a little bit of interest, and we're going to use that to repay the loan in 3 years' time. All right, so what do I need to do with this 1300? Well, it's €1,300 per month from the 30th of April. So April, May, June, all the way to December, 31st of December. That will be 9 months of payments. Okay. So there's 9 1300s being paid from the business bank account into this investment fund. So if you look there, there's no payment amount for that included. So they haven't told you you're paying this up here. So you're going to have to include this in that T account yourself, where you're trying to figure out the closing bank figure. So there's the bank account. So most of that's from the lodgements and payments. The 140, the 120 we've seen wasn't included. Down here is the 1300 by 9 months. Okay, so that's 11,700, and that's going in on the payments side of your bank account because you're paying that out of your bank account. Okay, the 11,700 then is going into an investment fund. And where have we seen investments in financial accounts before? They're usually on the balance sheet as a financial asset. Okay, and that's where they're going here. So the 11,700 is coming out of your bank account. So you put it on the payment side here. And then you go to the balance sheet. And after intangible fixed assets, after tangible fixed assets, financial assets, investment fund, this is where the 11,700 is going. Okay, as part of this number here. Okay, I'll deal with the other little bit later, but that's where it's going. Okay, so it's coming out of the bank account, so on the payment side there, and then you're putting it in as a financial asset, the investment fund. Okay, it's a little bit higher than 11,700, and the reason for that is if you go down to the information about assets and liabilities at the end of the year, assets include €150 interest earned by the fund to date. Okay, so like I said, that investment fund is like a savings account or a deposit account almost. Okay, so the money is sitting there, it's earning interest, and that interest then is added on to what's in the investment fund. Okay, so that 150 interest earned doesn't like move into your normal business bank account. It stays in this investment fund, and it gets added on to what you've put into the investment fund already. Okay, so you have 11,700 that you've paid into it, plus that 150 interest means it's now worth 11,850. Okay, the 150 interest is still interest income. So if you go up to the profit and loss here, you'll see it's got add other income, investment fund interest, 150. Okay, so look, most of that was like the one in the example up as far as maybe the interest. Okay, to deal with drawings, I don't think we have to deal with the other example. But what's different is rather than repaying it straight away and dealing with that, we're moving the money into an investment fund to repay it all in one lump later, and that's how you deal with that.